The state of the market right now is, to put it mildly, absolutely wild. We've got traditional valuation metrics flashing warning signs, speculative bubbles forming in the most absurd corners of finance, and a growing sense that something just doesn't quite add up. Today we're diving into why the market seems completely overpriced and what that could mean for you. Now let's start with one of the clearest indicators that the market might be in trouble. It's called the Buffett indicator. It's named after Warren Buffett. This measure, popularized by Warren Buffett himself, looks at the global total market capitalization of all publicly traded companies, compared to the GDP, or gross domestic product, of the economy. Think of it as a way to measure how big the stock market is relative to the actual economy it's supposed to represent. Historically, when the Buffett indicator gets too high, it's been a major red flag. And right now, it's not just high, it's the highest it's ever been. The stock market is priced like the economy is booming. But if you look at GDP growth, it's not nearly as impressive. In Buffett's own words, this kind of environment is like playing with fire. And let's add another piece to the puzzle. The S&P 500's PE ratio. The price to earnings ratio is a classic valuation metric. It tells us how much investors are willing to pay for each dollar of earnings. Historically, the S&P 500's PE ratio averages somewhere between 16 and 17. Today it's sitting at levels that haven't been sustained since the dot-com bubble. This tells us that investors are paying sky-high prices for earnings that may not even materialize in the economic conditions weaken. It's a sign that the market isn't just optimistic, it's downright euphoric. And as history has shown us, euphoric markets don't tend to end well. But it's not just traditional stocks that are showing signs of froth. Let's look at the absurdity of the crypto market. Specifically, the rise of meme coins like Fartcoin. Yes, you heard that right. A coin with little to no inherent value is approaching $1 billion valuation. How does this happen? How does this happen at all? It's a combination of hype, speculation, and frankly, lack of due diligence by investors. People are buying these coins not because they believe in their utility, but because they think they can sell them to someone else for more money. It's like a game of musical chairs in the meme coin casino. It's the greater fool theory in action, and it's a textbook example of a speculative mania. Now, this kind of behavior might seem familiar because we've seen it before, over and over again, in fact. One of the most famous examples is the tulip mania of the 1600s. Back then, people were paying insane prices for tulip bulbs, like the flower, convinced that these flowers were a pathway to wealth. It was a speculative frenzy fueled by the greed and herd mentality, and it all came crashing down in one of history's first recorded market bubbles. Today, it feels like history is rhyming. Whether it's overpriced stocks or billion-dollar meme coins, the same speculative fever is in the air. Another troubling sign is the narrowness of the current market rally. If you look at the S&P 500's performance this year, you'll see that most of the gains are concentrated in just a handful of stocks. Big tech names like Apple, Microsoft, and Nvidia. This kind of market concentration can be very dangerous because it means the broader market isn't as healthy as it appears. If those few high flyers start to stumble, it could drag down the entire index. And let's not forget about the role of interest rates in all of this. For years, low interest rates fueled a boom in asset prices, from stocks to real estate to cryptocurrencies. Higher interest rates means higher discount rates, which should, in theory, lower the present value of future cash flows. Yet, paradoxically, the market is still pricing assets as if rates are at historic lows. Another point worth mentioning is corporate earnings. We're seeing earnings growth slowing down for many companies, yet stock prices continue to climb. This disconnect is a huge warning sign. Investors seem to be completely ignoring fundamentals, focusing instead on narratives and momentum. But as we've seen in the past, when the narrative breaks, reality comes rushing back in, and it's not pretty. Here's something else to consider. Warren Buffett himself is selling. Over the past few months, Berkshire Hathaway has sold $133 billion worth of stock year to date. Now, this is a man who's famous for buying undervalued companies and holding them forever. So, when Buffett is a net seller of this kind of market, it's worth paying attention. It's a strong signal that he's seeing limited opportunities at current valuations. In fact, Buffett has been piling up cash, suggesting he's preparing for a downturn or looking to capitalize when prices inevitably come down. If one of the most successful investors of all time is stepping back from the market, shouldn't we take a closer look at why? Let's also revisit the dot-com bubble, the late 1990s and early 2000s. During that period, investor optimism towards US stocks reached unprecedented levels, particularly in technology and internet-based companies. Any company that had a website was soaring. Stocks were trading at exorbitant valuations driven by the belief that the internet would revolutionize business and society. A belief that wasn't entirely wrong, but was certainly overhyped at the time. When reality failed to meet these inflated expectations, the bubble burst, leading to massive losses for investors. Fast forward to today, and we're seeing similar patterns. Investor optimism towards US stocks has eclipsed levels seen during the dot-com bubble. This heightened confidence raises the risk of a negative market shock, as any unforeseen events, black swans, or economic downturns could trigger a sharp decline in stock prices. The parallels between the current market environment and the dot-com era are striking, and they serve as a cautionary tale about the dangers of irrational exuberance. Adding to the complexity is the unprecedented influx of foreign capitals into the US markets. In 2024 alone, approximately $1 trillion of foreign capital has poured into the US markets, nearly double what the Eurozone has attracted. This massive inflow has been driven by the perception of American exceptionalism and relative strength of the US economy compared to other developed nations. However, this concentration of investment in US assets has led to a significant valuation premium over the rest of the world, raising concerns about the sustainability of such disparities. Moreover, the dominance of the US companies in global stock indices has reached unprecedented levels. US companies now account for 70% of the leading global stock market index, a staggering rise from just 30% in the 1980s. This dominance reflects strong corporate performance and innovation, particularly in the technology sector. However, it also indicates a potential over-reliance on US markets, which could pose a risk to global financial stability if a correction were to occur. Another under-the-radar issue is the explosion of private debt. While public markets are grabbing headlines, the private market for debt has quietly ballooned to record levels. Private credit funds are lending at unprecedented scales, often with limited regulatory oversight. This hidden leverage poses a systemic risk. If the broader economy slows or interest rates continue to rise, defaults in the private debt market could spill over into the public markets, triggering a broader financial crisis. And let's not forget about inflation, which is still a wild card. While inflation has moderated compared to its recent peaks, it's far from gone. Persistent inflation erodes purchasing power and forces central banks to keep interest rates higher for longer. The result? Consumers and businesses face tighter financial conditions, which could dampen spending, could slow economic growth, and eventually drag down corporate earnings, none of which are currently priced into the stock market at all. One major driver of the current market rally has been artificial intelligence, AI. Companies like NVIDIA, which are the forefront of AI development, have seen their valuations skyrocket straight to the moon. While AI undeniably holds transformative potential, the level of speculation around AI-related stocks feels eerily reminiscent of the dot-com era. Back then, any company with .com in its name was considered a surefire winner, until it wasn't. Today, many investors are piling into AI stocks without fully understanding the technology or its realistic applications. This enthusiasm may be fueling another bubble within the broader market. Another unprecedented risk is the growing dominance of passive investing. ETFs and index funds have been soaking up massive amounts of capital over the past decade. And while they've been hailed for their low fees and simplicity, they also come with hidden risks. Passive investing doesn't differentiate between overvalued and undervalued stocks. It buys everything in the index indiscriminately. This has the effect of inflating valuations for stocks that don't necessarily deserve it. If we see a market downturn, the same funds could amplify the sell-off as investors rush to redeem their holdings. We can't overlook the psychological aspects of market behavior. A significant driver of today's inflated valuations is FOMO, the fear of missing out. Retail investors in particular have been chasing gains in high-flying stocks and speculative assets, fearing they'll miss the next big opportunity like GameStop. This herd mentality often leads to irrational exuberance, where prices are driven higher not by fundamentals, but by a collective belief that they'll just keep going up forever. History shows that these behaviors tend to reverse sharply when the sentiment shifts. Another looming issue is the role of hedge funds and their use of leverage. Hedge funds have been borrowing heavily to amplify their returns, often making concentrated bets in sectors like technology and AI. While this strategy can generate outsized returns during bull markets, it also creates significant risks during downturns. If even a few of these funds face losses or margin calls, the ripple effects could spread across the financial system, potentially triggering a broader crisis.
Everybody panic! Oh my God!
So, what's the takeaway from all this anyway? The market is overpriced, and the warning signs are flashing red. The Buffett indicator is at record highs. The S&P 500's PE ratio is dangerously elevated. Speculative bubbles and meme coins and tech stocks are thriving, while corporate buybacks and private debt conceal deeper vulnerabilities. Add to this the parallels of the dot-com bubble, the dominance of the US assets and global markets, Warren Buffett's massive selling spree, and the overexuberance around AI stocks, and it's clear that we're walking a very thin financial tightrope. The big question remains, how long can this go on? History has shown us that bubbles eventually burst, and when they do, the fallout can be severe. If you're an investor, this is the time to be cautious. Stick to the fundamentals, diversify your portfolio, and don't get swept up in the hype. Because when markets start feeling like casinos, the house usually wins. Thank you so much for watching. A subscription to my YouTube channel is free, so it's way less overpriced than the stock market. So if you enjoyed this video, please give it a like, subscribe, and leave a comment down below telling me if you think that the market's overvalued or if everything's cheap and fart coins going to $10 trillion. Thank you so much for watching, and I'll see you next time.